So we get a question a lot. We've talked about China. It's one of the largest absolute weights and relative overweights in the portfolio. India is another area in the portfolio where there's this significant exposure. And I have both the macro question, the country question, but I also want to tie this back to the holdings and how the portfolio is positioned. So we hear a lot about the potential, the growth in India, the long-term growth opportunity, and that India is in fact the next China. I know you have a very differing point of view on that. Can you talk about, kind of compare and contrast the two countries, but why you don't think India will be the next China, and really what if the long-term growth opportunity is a little challenge there, how is the portfolio positioned? I know you invest in exceptional companies, but I'd like to kind of dive into that a little deeper.
So when I say India is not the next China, there is no next China. I think that's a very clear, there will be no other country that develops as rapidly as China does on the scale that China has. India, of course, is a proximate neighbor of China. It has relatively the same population. It's an economy of about $2 trillion. China is an economy between $10 and $11 trillion. So 5 times larger than India. So mathematically, is it possible that India actually outgrows China? It is possible in terms of growth levels off of a much lower base. If the leaders are so determined to keep growth at 6%, what they can, or whether it's appropriate or not is another issue, but if they do, is it possible that India could grow faster than that? They certainly did last year. But when you look at 7% growth in an Indian context on an economy of $2 trillion, that's $140 billion. When you're looking at 6% on the base of $11 trillion, that's $660 billion, 4 times, 3-4 times as fast. So, we don't get bothered about the numbers, but what is really important is what are the opportunities within that growth that are investable for us, and where are there opportunities that are defendable? We're not just growth junkies to be growth investors. We want sustainable growth. We want circumstances where companies have defendable growth and they have a whole host of options to extend their advantages into new segments, oftentimes through innovation. In the context of what we own in India, it's roughly half-half between the domestic economy and exporters. And half-half meaning, we have at the moment 13-14% of the fund, roughly in India.
A little bit less, but yeah.
So roughly half of that is in IT exporters. So that's our very large holding in Infosys, a smaller holding in Tata Consulting. And then we have sort of 250 basis points in Indian pharmaceuticals. So that's really half of the fund. That half of the fund is sort of, if you look at China, China is extremely competitive across many different industries as the world's largest exporter. In the case of India, one of the problems, of course, is because of infrastructure and policy, the only significant, world-beating competition or exporters that India has bred tend to not be those that employ tens of millions of individuals and kind of lift the country out of poverty. They tend to be actually on the high end of the value side, so software and drugs. And so half of our fund is invested in those companies. And then the other half is concentrated in more India-centric businesses, the largest of which is our single largest holding, HDFC, the mortgage company that also is a conglomerate that has a holding in India's largest bank by market capitalization, one of its leading private sector insurance companies. And then we have some smaller positions in Zee, for example, which is a media company, where the revenues are sort of balanced, 3/4 in India and 1/4 exporting content. And then we've got much smaller holdings, things like Ultratech, that are entirely about India.